Today we're actually going to cover two terms. The first is balloon mortgages.
What is a balloon mortgage?
It is a loan that does not amortize in the way that, say, your traditional 30-year fixed mortgage does. On a 30-year fixed, you're going to make level monthly payments over the entire life of that loan, naturally paying off the balance at the end of the term. On a balloon loan, what you're going to do is take a period of time, say 5 years or 7 years, but at the end of that balloon term, the entire payment on that loan comes due at that time. These loans could include something like a construction loan. You might have a balloon term built into that. And basically what the bank's doing in that case is they're saying, we're okay to fund this project, but we're going to need you to replace this temporary loan with a permanent loan once you're all done. Another couple common cases, a home equity line of credit. These are open-ended lines of credit attached to your house. The way a Heloc works is you've got a period of time where you can actually draw on that line of credit. And then there is going to be a balloon term typically built into that allows the bank to have you either pay the loan off in full or refinance into a new home equity line of credit. A couple other cases where you might see a balloon feature in the world of residential financing would be a lot or land loan and also on bridge loans. Balloon loans were actually seen as a benefit in times of very, very high interest rates. In 1981, mortgage interest rates peaked on the 30-year fixed mortgage at about 18%, with approximately 2% due in discount points. At the time, given how amazingly high that interest rate was, what you could do is opt for a balloon term to be built into that mortgage. And typically it would save you maybe 0.25% off that rate, maybe 0.5 point, maybe sometimes a little bit more. All right, on to the next term we're covering today. What I'm going to do now is pop the myth of biweekly mortgage payments. I'm reminded of a phrase that sometimes things can be factual while not being truthful. In the case of a biweekly payment plan, what you typically have are some advertisements that highlight some things that are factual. But as we're going to see when we take a look at the numbers here, if the average consumer knew how this outcome was really being achieved, I would bet that many of those that signed up for these biweekly payment programs, especially the ones that paid an admin fee in the $400 to $700 range to set it up, may have opted to go a different direction. So here's the pitch on biweekly mortgage payments. Let's say you're buying a $300,000 house and you're going to put 10% down. So you're borrowing $270,000. Now in this hypothetical example, let's say that the 30-year fixed rate was 3.0%. What that's going to give you on a typical monthly mortgage payment is a principal and interest payment of $1,138 per month. Why not just every 2 weeks pay $569, which is half of that monthly payment? By converting into a biweekly mortgage payment, you're going to shave off almost 4 years on the payoff on your loan. And by doing that, you're going to save over $19,000 in interest payments. While these statements are factual, there's one little detail that's completely left out of this equation. The thing that gets left out is actually going to be very obvious to anybody that is paid every 2 weeks. You know that there are 2 months out of the year, these 2 magic months, where you actually get 3 paychecks for the month instead of 2. In the case of a biweekly mortgage payment plan, that exact same principle applies. There are going to be 2 months out of the year when you're under this biweekly payment plan where you actually make a total of 3 payments. What this works out to mathematically is exactly the same as making an extra payment per year. And really, you could make that extra payment in one lump sum, or you could take your monthly mortgage payment, divide it by 12, add that amount on to your total monthly mortgage payment, and you achieve the same exact result in the end. What I really don't like about these programs is the way they are advertised. It really leaves out this fundamental reality. If you want to pay your loan off faster, you have to pay more. Well, if you want to pay more, that's totally up to you. To me, there's no value at all in, say, paying one of these companies to set up biweekly payments for you. So there you have it. I hope that you found this explanation of mortgage terminology useful. I am going to continue this series, so please do subscribe to my channel for future content. I talk about mortgage interest rates, I cover all sorts of aspects of the mortgage process. Really what I'm trying to do is to break down this complicated process into something that is very user-friendly and understandable for the typical consumer. I would be more than happy to talk to you about your personal mortgage questions. Give me a call, shoot me a text at the number below anytime. Thank you so much for watching. I'll hope to talk to you again soon.